Hey traders, this is Blake Morrow with Trader Summit. Make sure you join the most highly anticipated online free trading event of the year, October 21st through 23rd at tradersummit.net. We're gonna have so many great speakers for you for those 3 days. We have speakers like Danielle DiMartino Booth, Brent Donnelly, Mark Minervini, Peter Schiff, Danny Blanchflower, Helene Meisler, and many, many more. So make sure you do register, it's free. Also, our sponsor Eightcap will be giving away 2 iPhone 14s to 2 lucky winners just for registering. So what are you waiting for? I'll see you there. Hey traders, this is Blake Morrow with Trader Summit, and with me once again, I have Adem Tumerkan he's the actually founder and author over at Speculators Anonymous, and who used to be in my neck of the woods, but now you're in Northern Arizona. Good to see you, Adem. How are you?
I'm doing good, Blake. Thanks for having me again.
Yeah, no, it's great to have you here. I always love, I love your insights. You're from a different generation than me, but you think the way that you think about the macro point of view in the markets, I love it. And I know our traders love to hear what you have to say as well. And you're not a foreigner to our interviews and with our Forex analytics community, also the Trader Summit community. So it's always nice to hear your views. But last time we talked, which was, I want to say June 30th. So it was at the end of June, beginning of July. We were discussing about, you had thought there was no way the Fed is going to be pivoting. And here we are 4 months later, and you've been right. And the Fed still seems hell-bent on raising rates. And it looks like even after today's data, or this week's data, it looks like the Fed is pretty much going to raise rates at least another 0.75%. So what are your feelings about the Fed, and do you think that people should even be thinking about a pivot?
I mean, it's always hard to say. Usually, historically, a pivot happens once something breaks. Like we saw it in 2019 with the reverse repo September squeeze.
Yeah.
For viewers that are not familiar with it, it was when the corporations. There's 2 main tax seasons. There's September and then April, and they were doing early taxes, but because the Fed was draining liquidity out of the system, there was a reserve shortage. When all those corporations went to pay those taxes, pulling their money out, it sent reverse repo rates through the roof. Like the Fed technically lost control of the short end of the curve for basically a day. And ever since then, they've been doing unlimited reverse repo. And, even before that, 2006, Greenspan hiked, and then Lehman went up, and then they had a cut. They tried it in 2015, 16, they had a pause multiple times. So usually something has to break. I think the Fed at this point is behind the curve just because I know I get a lot of flack for this, but a lot of the inflation I think we saw after COVID was supply driven. Like there's the 3 types of inflation. You got monetary, which is, obviously currency erosion, adding volatility to basically demand and supply problems. Then you have demand pull, which is if, let's say you're a farmer, and every year you're producing the same amount of crops, but the population is increasing or whatever, the prices will go up because of higher demand. And then you have the supply side, which is known as cost push, which is like 1970s when the oil embargoes happened. It sent oil prices through the roof, which led to a lot of inflation. And then the 80s, once more oil came online, prices fell, and we had 20 years of deflation. So I think a lot of post-COVID was mainly supply side. Then you had the Fed and the government pouring gasoline on it with PPP loans, direct stimulus checks 3 times, mortgage pauses, student loan pause, everything they could do just to aggravate the supply side imbalance even further. And then at the same time, I think historically, looking back, economic historians are scratching their head at what the Fed did with the mortgage-backed security market. They were just pouring gas on a fire, buying those bonds, and now they're stuck with them. And the bigger the boom, the bigger the bust.
Yeah. Well, yeah, it is. The analogy I like to use is we've had a hell of a party the last 13 years or so, maybe more. And, we're going to have a hell of a hangover, right?
Yeah, I agree. And I think it puts the Fed in a tricky spot because they're trying to tighten. But as we've seen, even though they've been tightening all year, I think inflation, I said it back in June, I think inflation peaked then. If oil goes back higher, maybe, it'll trend up, but the recent CPI is still, in month-over-month terms, it's been declining. But at the same time, it's not declining fast enough, which in my opinion, just shows that a lot of these inflation was sticky, prices, wages. And for individuals who aren't familiar with that, sticky wages and prices, back in the day, pre-1930s, when there was deflation, workers would get like lower wages. They'd cut their wages, keep everybody on. Prices would also come down further. But since the 30s, mainly after FDR, Keynes pointed out, he said, now that you have so many unions and cartels in the corporate world, they can come together and basically put floors under these things. So he said that's why you don't see deflation bring down wages anymore or bring down prices as much. It just kind of it declines in the rate of change each year in its growth, but you never see it really fall.
So how do you? Let me ask you this: with the sticky inflation, where do you see it peaking? I mean, I know you say it's sticky. I get it. And I get it. A lot of it has to do with housing and everything else, but when does it peak, and where are the signs what are the signs that we will see?
So yeah, so one thing you learn in studying complex systems, which I think economics markets are complex systems, there's always a lag effect. You have amplifying feedback loops that feed on themselves, like stock markets, higher prices beget higher prices. People get more elated, pushes prices higher, et cetera. And then on the way down, it just compounds faster and faster. And then there's ripple effects. You try to fix one problem, it creates three more. And then on the last part, you have lag effects. And I think that's the most important thing in markets right now, is that so by the time we realize we are in deflation or recession, it will be backwards data. And that's what I'm worried with the Fed, because just like they did with the inflation, in my opinion, they should have been tightening so when you have basically you have the fiscal, there's a thing called like the fiscal put, which is more or less when the US government comes in and bails everything out. Same with the Greenspan put. Since the 90s, every time the market takes a big drop, the Fed usually steps in. So when both sides ease and tighten, historically, when one side's tightening, the other eases, and vice versa. Well, the problem with 2021, after we already had 2020 massive deficit with a lot of spending. Then 2021 wasn't better with the Biden's $1 trillion build back nonsense. And then the Fed is also just pouring gas on the fire. In my opinion, they should have been tightening in 2021, forecasting this. But historically, they're always behind the curve. And that's what we're seeing in the bond market. Bond market is the 10 to 2-year yield curve is inverted 50 bips at this point. It's like at a multi-decade inversion. And it's just showing that, like, hey, Fed's way behind the curve. There's going to be really big cuts coming probably in the next year, I'd imagine. Historically, there's like a 12 to 14 month lag. So, the sticky wages and things you were talking about, I think we're going to see it for a while because, it's so entrenched in the market. There's so much liquidity sloshing around even today, not for the bottom 90%. Bottom 90% are getting squeezed out completely. Wage growth, I was reading the average hourly earnings, even with like advancing wage growth, it's been negative the last 10 out of 12 months. So no wonder everyone's getting poorer. I mean, you're not having real wage gains. I think since the 1980s, the bottom 90% wages have only increased 25% from last I saw at the EPI, Economic Policy Institute.
So housing has obviously been a big issue for many Americans. When does that change in your view?
So yeah, housing is tough. And I've talked about this before. The problem with housing, and there's a lot of empirical evidence on this right now. Actually, MarketWatch did a great article. The cities with the tightest building restrictions have the highest prices. And it makes sense. There's a perverse incentive as a homeowner because you don't want more supply on the market, right? You don't want more buildings because your mortgage you took out, you're like, hey, I don't want my house value to go down compared to the mortgage I took out. Yeah. So you're seeing communities now who are becoming homeowners preventing more supply from coming online. And we're seeing it in Portland, especially San Francisco, especially. It's happening in Scottsdale too. These local municipalities are restricting further construction than should be. I think housing has been a big problem of supply and demand, and the Fed just buying mortgage-backed securities, like I said, is just adding fuel to an already aggressive imbalance in the market. And I'm expecting that there's two ways to look at it. I think that with this, as the Fed continues tightening, it's going to squeeze out a lot of marginal buyers out of the housing market further.
Yeah.
I know a lot of friends who, like you and I are both in Scottsdale. I know tons of people. My girlfriend, who was an underwriter at a big mortgage company, got laid off. I know tons of people. There's no volume, but house prices aren't really dropping that much. And it's because the market is so tight right now. You have BlackRock, big companies coming in, holding up demand, squeezing people further out, rents going up, especially with taxes. And the higher the home values, the more your taxes go up. So it's, really putting pressure on a lot of individuals.
It's an interesting phenomenon. And plus then you throw, I guess, the work at home aspect of it, where, a lot of workers refuse to go back to the office. They seek employment where they can work at least part-time. So that means they're going to be looking for that extra bedroom. They're looking to actually upgrade or buy something bigger versus it's a weird dynamic. Well, Adam, let me ask you this. Help me and our traders in our community understand how to take advantage of this in the markets. Like, how am I going to express your thoughts in the marketplace? Like, what would you be doing right now?
So I've been mostly in cash like all year, just waiting. And why not? You're collecting yield at least for once, risk-free yield. But I think I would say I'm looking for breathing points, like where markets will rally, like we saw yesterday. S&P shot up 3% almost. Yeah. And I'm looking for those opportunities to continue buying puts. I think consumer discretionary spending, those kind of things are going to be squeezed. Things like, this is an investment advice, obviously, but things like Best Buy, Burlington Coat Factory, Nordstrom, these places, they're not to mention they're drowning in excess inventories. That's been a big problem this year, is all these firms loaded up on so much inventory in 2021, liquidation. Now they're liquidating everything. I was walking with my sister into Ross, and they had 80% off in the front. They literally, but the parking lot was empty. Just no one's there. They're just trying to get rid of stuff. They had tents outside with stuff. So obviously that's anecdotal, but I do think that those things you're going to see. I think there's going to be a corporate earnings recession. I think we're already seeing that in the South Korean trade data, China and everything slowing down, South Korean trade data, global trade volume plummeting. So I also think global shipping freight rates are down some 85, 90% in the last year, back to their means. But the problem is, I was reading recently how in 2020, 2021, because of the high prices, so many freight companies started building more shipping containers, and they're not going to be fully built by 2023. Now freight rates are back down to 2018-19 levels. So I think they're going to have to shed the excess. So, I'm looking at puts on pretty much everything. I just think as far as the Fed tightens, until something breaks and they're forced to try to pivot, I know some people have said Credit Suisse, which is blown up phenomenally. Who knows? I think they'll probably bail it out, or someone will. I mean, we saw the same thing with Deutsche Bank in 2015. It got dangerously close to going up, but the credit default swaps right now are looking bad. High yield credit spreads are looking bad. I think we're going to see corporate bankruptcies. And
so can we buy calls on the Fed opening credit lines to different banks? Can we do that?
I wouldn't be surprised.
I know it's a joke, but it's not.
Yeah, I think as long as the yield curve is inverted, because a lot of individuals think it's just a random metric, but actually there's a lot of precedence with the yield curve inversion, because when the yield curve is inverted, banks have to borrow ever since 2008, basically. So back in the day, banks had to borrow from each other. Usually it was frowned upon to borrow from the Fed. There was the interbank lending rate. So if Bank of America at the end of the day didn't have enough of their reserves, they go, hey, JP Morgan, whatever, Chase, Wells Fargo, can we borrow, $2 billion or whatever they needed? And they lend it at whatever the interest rate was. But ever since 2008, the Fed's been hey, stop borrowing from each other, borrow from us for 0% or 0 to 2.5, when they kept it there for 10 years almost. Yeah. And banks just splurged. There was no point in watching reserves ratios, and they were speculating with a lot of it. And I don't blame them. It's free money. But now that they're hiking, and when you're seeing the yield curve invert, that means they can't borrow cheaply anymore, and they're trying to lend. Besides mortgage, a lot of rates 10-year bonds and everything are still They're like barely above where the Fed had. I mean, actually, no, it's pretty much the entire curve's almost inverted at this point. So I think banks, there's a lot of empirical evidence that shows when the yields invert, banks curve lending. And like we know, how money expansion comes in the economy, liquidity, banks have to make loans. Underwriting loans is what creates liquidity. And if they're not underwriting loans, we're going to just see liquidity dry up.
Wow, Adam, you paint a bit of a dire picture, but I want to end on a positive note. So aside from the Fed, a Fed put, just a straight up Fed put, something breaks. Is there anything else that you'd be looking for that says, that looks like we're getting close to a turning point and things are going to start looking better, and we can see the light on the other side of the tunnel? What are your thoughts there?
Well, yeah, I mean, that's true. I don't want to sound too doom and gloom because it's a big world economy. I mean, people are spending every day. There's still money to be made, money to spend. So there's a thing, mean reversion. And last I checked from my own calculation that even if month over month inflation was 0 for the remainder of the year, and this was back in July, inflation would have still been above, CPI would have still been above 6%. And it makes sense because it was so low in 2020, and then export and everything soared so much, and year over year terms, it exploded. My guess is in 2023, now that the rate of change is decelerating inflation, which I think like I said, I still think we saw the peak in June. I'm not going to bet the house on it, but I believe looking at momentum, that's where it's at. We're going to see it decelerate more. And then in year over year terms, we're going to see it start declining. And I think once we see it get to maybe 6 or 5, the Fed will probably be like, hey, we're going to take the foot off the gas. Or if we start seeing like, millions of job losses happening. I know they say the labor market's tight, but that's skewed to me in 2 ways, because if you look at the non-participating labor force rate, it's down significantly over the last 20 years. So that makes the ratio of employment numbers look smaller because you have less people out there working.
Yeah.
And so it artificially pushes the rate down. And I'm sure the Fed looks at that, but at the same time, there's no easy fix for that. I think demographics is a big problem for this going forward. Because productivity, labor plus productivity equals GDP, basically. And we're seeing demographics fall everywhere. China, especially. China has like 300 million people retiring in the next 6 years, I think. It's the largest demographic cliff there is right now. And then you're seeing productivity drop everywhere. Total factor productivity has plunged all over because there's just no more marginal productivity to be made. I don't know, and especially with China slowing down now.
Yeah.
But yeah, so I don't know. It's a big economy. I think if you're saving up on cash and you're getting ready, you find companies you like, it's a good buying opportunity for a lot of assets. I mean, a lot of these companies aren't going to go bankrupt. It looks bad, but tomorrow the sun will come up. Everything will, most of them I would imagine will survive.
All right. Well, Adam, it's always great catching up with you. If I'm a trader and I'm like, man, I really like what this guy's doing, how do people follow your work?
Yeah, you could just follow me on Twitter at Radical Adam, and it's Adam with an E, ADEM, or my website, speculators.anonymous.com. I'm pretty easy to find, though. There's not
you're great, and I'm glad that you're here spending time with the Trader Summit community. And for those of you that are just hearing about Adam for the first time, give him a big thumbs up and subscribe to this channel so you don't miss any of this exclusive content. Make sure you do register for our event October 21st through 23rd. And Adam, you do the same thing too. We got a lot of great speakers. You should be listening in.
Yeah, I'm going to. I really appreciate it.
All right, Adam. Well, hey, thanks for joining us today, and we'll catch you soon.
Okay, great. Oh, before we go, I just want to say anyone who's interested in like liquidity flows or anything, I recommend the book Where Money Comes From by Richard Werner, who wrote The Prince of Yen, the same author, and Central Banking 101 by Joseph Yang. I know it's kind of a corny name, but it really explains the plumbing of like the financial system in an easy to digestible way.
And well, the great thing is we'll have Joseph Wang with us in a week and a half, in a week.
Oh, wow.
Over at for the event. So yeah, we'll see
awesome.
Joseph there. He's going to love that plug.
Well, he come with anything. So I appreciate his work. And I look forward to seeing him.
All right. Sounds great. Thanks, Adam.
Great. Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.